skipping to our left tail risk section, this is, we continue to have a view that we're kind of inning 8, inning 9 of the broader bull market cycle. And again, this is probably a secular bull market aided and abetted by AI and the proliferation of AI, deregulation, tax cuts, etc. So you could have a significant correction in the context of a secular bull market, much like what we saw in Q4 18. And that's something that we expect to see, at least from a fundamental standpoint, currently, sometime in the middle of next year, or second half of next year. Who knows when it'll start? But we have, a large, increasingly a large and growing amount of evidence that suggests we're probably in inning 8 or 9, and probably headed for a Q4 18 type event in 2025. We may be wrong on that. And again, that's why it's in the left tail risk section right now and not in the modal outcome section. We're just trying to paint the full distribution of probable economic outcomes so that when asset markets, which are currently pricing in risk on reflation, if asset markets migrated to pricing in something like risk off inflation or risk off deflation, you'll have been listening to me talk about all those risks for 6, 7, 8, 9 months. And so you'll have confidence to react to make the proper pivots in your portfolio if and when Kiss and Dr. Mo tell you to take down risk. And you'll have a lot more confidence in understanding how long is a risk-off regime might last, or how deep might a market correction might be. That's why we do our fundamental. That's the whole point of this presentation here, these monthly macro scouting report presentations. I'm not talking for an hour and a half every month to try to convince you to go buy this or go sell that. That's what Kiss and Dr. Mo do. You don't need my words to figure out what we want you to do from a risk management standpoint. The words, the charts, everything else is trying to help you get confidence in what those signals are currently signaling and what they might signal in the future over various time horizons, depending on how big or small and how nimble or not nimble you may be as an investor. Don't forget, we have a very, as wide as the current distribution of probable economic and financial market outcomes is currently, we have an equally wide distribution of clients. We have several clients that manage trillions of dollars of AUM, in the sense that we also have several clients that manage maybe a few $1,000. You know what I mean? Like, we have a very wide distribution of clients. We pride ourselves on being one of the very few research providers on Wall Street that sells the exact same information that we do to our 100th percentile client in terms of sophistication as we do to our 0th percentile client in terms of sophistication. We want to narrow that information asymmetry that Wall Street has historically profited from at the expense of Main Street. And we're fortunate to have a collection of very large, sophisticated, and well-respected buy-side clients on our behalf that are on our side that believe in what we're trying to do here for the rest of the world and for Main Street. And so we appreciate them, and we appreciate each of you guys on Main Street for tuning into each of these presentations. So let me stop bloviating and just hop into the left tail risk section. It's not enough to know that global liquidity is currently trending higher. You must accurately forecast it if you want to make money in asset markets. And so we know what leads global liquidity from both a medium-term and long-term time horizon perspective. We'll talk about the medium-term key leading areas of global liquidity. It's global stock market capitalization, global crypto market capitalization, the U.S. dollar real effective exchange rate, the currency volatility. It's the global interest rates. It's global bond market volatility. It's global growth. It's global inflation. It's global employment. And these things all lead the year-over-year rate of change of the 42 macro global liquidity proxy on a 3 and 6 month leading basis. And so in terms of trying to forecast global liquidity, what we're trying to do here is take the latest values of these indicators and look at them on a correlation adjusted z-score basis. And then we sum all that up to figure out, okay, where do the based on how these things are currently aligned, how are they currently aligned? What do they imply about the growth rate of global liquidity? Where should the growth rate of global liquidity be right now? And right now, those things suggest that the growth rate of global liquidity is a little bit too low. These leading indicators are suggesting that the growth rate of global liquidity needs to catch up to where those leading indicators have already been, because again, these are 3 and 6 month leading correlations. So the key takeaway is that the key leading indicators of global liquidity currently signal a modest increase over the medium term. But again, we're in the left tail risk section, so let's talk about the left tail risk. The currently projected modest increase in global liquidity may flip to a modest or significant decrease if the US dollar continues to rally. So recall, we just talked about US dollar and currency volatility are two of the key leading indicators of global liquidity. If you look at the year-over-year rate of change of the real effective exchange rate, US dollar real effective exchange rate, obviously inversely correlated to global liquidity, as is currency volatility, which is positively correlated to trends in the US dollar. So if we continue dollar strength, which will likely cause continued currency market volatility, you're probably going to have the growth rate of global liquidity moving in the wrong direction over the medium term. Incremental tariffs would likely result in a stronger U.S. dollar, or at least that's the experience of what we saw in 2018. So you go back to 2018, on March 6th of 2018, we had the first Trump-China trade war tariff announced, or either announced or implemented. And from that point forward, U.S. federal customs receipts doubled from the end of March of 2018 all the way through, or just, in a few short months, 9 short months to the end of 2018. Throughout that process, we had the U.S. dollar, which is indexed to March 6th of 2018 here in this panel, climbed 7%. And then we had the S&P 500 from index to March 6th of 2018 decline 8%. But don't forget, we had a 20% correction in the stock market in Q4 18, partially as a function of a runaway U.S. dollar strength sucking global liquidity out of the system. So U.S. dollar strength tends to suck liquidity out of the global financial system by inflating debt service and refinancing costs. So if you look at the U.S. dollar share of global total, specifically with respect to cross-border bank lending, 60% of cross-border bank lending and 70% of international debt securities issuance is in debt securities outstanding is in U.S. dollars. So if the dollar continues to rise, then you're going to inflate debt service costs, and you're going to inflate refinancing costs, and ultimately slow down the growth rate of the private sector liquidity creation through the lens of corporate profits and household savings. And so this is something that investors need to be aware of. We can't have too strong a U.S. dollar, in the context of this America First policy agenda that we have with the incoming Trump administration, because ultimately it's going to cause some significant problems in asset markets through the lens of a strong U.S. dollar. A continued U.S. dollar strength would contribute to elevated risk of a global refinancing air pocket in 2025. And so when you think about what leads the global liquidity cycle on a multi-year time horizon, because recall that we've previously been talking about a multi-quarter time horizon, on a multi-year time horizon, it's the lagged growth rate of total non-financial sector debt. Across hundreds of economic indicators that we did a big deep dive empirical study to determine this, this was the tightest correlation with respect to the 4.5 a year sort of lag. So essentially what it's saying is the growth rate of global debt on a 4.5-year lag to simulate the kind of median mean lag of the refinancing cycle relative to when that debt is issued. Historically, that's produced a really tight correlation with the growth rate of our global liquidity proxy, but not in every instance, right? It typically has a tight correlation, but there are plenty of times where the correlation breaks down, and that's what we highlight in the red boxes. And the boxes are red for a reason, as you'll see on the next slide. The box is red during the global financial crisis. We had a big divergence between the growth rate of the lagged growth rate of total non-financial sector debt, global total non-financial sector debt. We had a pretty big divergence in the red line, the blue line in 2011 as well. We had a big divergence in 2015, 2016. We had a big divergence in the second half of 2018. We had a big divergence all throughout 2022, and we potentially could have a big divergence heading for right smack down our way, all throughout 2025. And so you got to be concerned about this, because the red boxes correspond to the global financial crisis, the European sovereign debt crisis, the kind of China deval, U.S. corporate profit recession in 2015, 2016, obviously Q4 18, and then 2022 was the most recent, global refinancing air pocket that had significant market impact to the downside. And so if that's the case, then if we had continued dollar strength with these dynamics as the starting point, and already, not the best trend in the growth rate of global liquidity, we could be headed for some serious risks in 2025. And in fact, until you tell me we had a falling dollar and falling interest rates and more monetary stimulus from the major central banks that can kind of offset this, I think you have to assume as your base case scenario that this is going to cause problems at some point in 2025, but not necessarily from today's starting point. Reminder: global refinancing air pockets cause trending risk-off market regimes, and this is the risk that we're signaling here in the context of slide 61 and 62. So in this chart, we show global total non-financial sector debt, and then we show our global liquidity proxy in the blue line and the S&P in the red line. And what we found is that when you look at what the black dotted lines indicate are the trough values in the S&P 500 for each of these major drawdowns that we just highlighted. And each of those drawdowns in the S&P 500 coincided with a drawdown in total non-financial sector debt globally or our global liquidity proxy. So essentially, the key takeaway is that when you have a global refinancing air pocket, which tends to get aided and abetted by a drawdown in global liquidity, you typically have significant problems in asset markets, as evidenced by the max drawdown analysis here. So a drawdown so we had a refinancing air pocket in the GFC and a drawdown in global liquidity. We had a refinancing air pocket in the middle of 2010. We had a refinancing air pocket in the middle of 2011. We had a refinancing air pocket and a drawdown in global liquidity in 2015 and 2016. We had a refinancing air pocket in 2018. We had a drawdown in global liquidity in 2020. We had a refinancing air pocket in 2022 and a drawdown in global liquidity in 2022. And then we had a refinancing air pocket in the summer of 2023. So investors, we got to be careful as investors not to extrapolate, kind of these loose, very loose, theses around U.S. fiscal policy, like, oh, deregulation and tax cuts. I mean, we think, by the way, we're in the camp of people who think that those things are coming. But again, it's about the size, sequence, and scope of U.S. fiscal policy implementation that will ultimately determine the evolution of the market regime. If we have a bunch of good things front loaded, then the market regime could stay, risk on. If we have some bad things get front loaded, you could potentially have a, trending risk off market regime to have to risk manage at some point in 2025 before we get to all the nirvana associated with the tax cuts, deregulation, and productivity and all that good stuff. So investors need to be aware of that. It's not about this destination. We talk about this in our behavioral analysis. It's not about the destination. It's about the journey. The journey is what matters to your financial and physical health through the lens of the stress you might experience as an investor, living through one of these with your portfolio significantly underwater. The reminder, the U.S.'s net international investment deficit doubled to $20 trillion in the 5 years through December of 2023. At $20 trillion in terms of our net international investment position in the U.S. economy. So what that means is foreigners own $20 trillion of U.S. assets, which doubled from $10 trillion in 2018. I mean, like I said, it doesn't sound like a lot, but if you think about the fact that the U.S. economy has been around for almost 250 years, we doubled our net international investment deficit in only 5 years, right? So that there's just been a big flood of capital, just from every economy in the world, from China, from Europe, from South America. Pick an economy where we used to have, or global capital allocators used to have assets on their balance sheets. Now everyone's just hyper focused and overly concentrated in the U.S. dollar, as evidenced by this doubling of our net international investment position. Foreigners own $10 trillion more in U.S. assets in the 5 years through December 2023 than they did in December 2018. So to me, that's a meaningful risk in the context of this slide here, which suggests that foreigners will liquidate U.S. assets and other stores of value if a strong dollar threatens their ability to service debt. So these charts, these plots are indexed to the end of 2021. And so this is what happened throughout the first 9 months of 2022. We had dollar rise 18%, commodities rise 15%, and the confluence of that, but primarily the strength of the U.S. dollar, caused a 10% decline in gold, caused a 25% crash in the S&P 500, caused a 31% crash in the long bond here in the U.S. And then from December of 2021 to September 30th of 2022, we had a 58% decline on Bitcoin, which is part and parcel to a roughly 75-80% decline that began in November of 2021 that we got you out of in December, at the beginning of December of 2021. So, heroic call in helping clients, sidestep all this negativity in 2022. And what we're trying to do here is, set the stage for potentially helping you sidestep significant amount of negativity potentially in 2025 to the extent that our triple S's theme, which is what we're talking about, goes awry. If the negative aspects of the triple S's theme kind of come before the positive stuff, then we could see something that looked like 2022 or Q4 18 in 2025. So that is a left tail risk that we need to be very cognizant of as investors. If Congress, and so that's dollar strength through the lens of tariffs and just general U.S. exceptionalism getting persisting or getting exacerbated. Another risk we're thinking about in the context of the triple S's theme is the fact that Congress could potentially vote to punt on the debt ceiling moratorium. And if they do, for any reason, it will delay the $700 to $800 billion of Treasury general account spend down that we are currently projected for Q1. So recall that the debt ceiling moratorium expires on January 1st. And so it means the Treasury will be without borrowing authority, at the beginning of next year. And so it's going to be, the clock will be ticking from that point for Congress to legislate a debt ceiling increase. And the reason this is important from an impasse perspective is because you need 60 votes in the Senate to legislate an increase in the debt ceiling. You can use the budget reconciliation process to legislate an increase in the debt ceiling, but there's no way in heck that they're going to be able to do that in the small amount of time they have between the clock striking zero or hitting midnight on January 1st to when the Treasury is probably going to be out of funds. right? Don't forget, they got to use reconciliation, like most likely, to to permanently extend the Trump tax cuts and get any other tax cuts and income subsidies that the Trump administration wants in this first budget. So in our view, the reconciliation is probably going to come in the second half of next year, in terms of that. So they may decide to punt the debt ceiling into the second half of the year and use and they may decide, the Democrats may decide to punt on the debt ceiling in order to have some concessions in the budget from a reconciliation perspective, but they may not. And so we're currently operating under the belief that we're going to hit the debt ceiling on January 1st. Treasury will be without borrowing authority for the first 2 months of the year, and we're going to go from $815 billion currently to essentially $0 in the Treasury general account. That's obviously incredibly bullish from the perspective of 42 macro net liquidity, which is, as you know, the fifth balance sheet, total assets minus the TGA balance minus the RRP balance, which is everybody's U.S. liquidity model now, thanks to our friends over at Morgan Stanley. How you guys doing? Meanwhile, the U.S. government's gross borrowing needs continue to skyrocket. So if you look at approximate next 12-month marketable Treasury debt supply and impact on interest expense, right now, so that number is 12.5 trillion currently. How we approximate that is the sum of the marketable U.S. federal debt maturing in the next 12 months at $9 trillion. Then we annualize the fiscal year to date budget deficit at $3 trillion. It's going to come down from there. It's probably around $2 trillion once it all said and done. But right now it's $3 trillion. And then the annualized rate of divestment from the Fed's Treasury portfolio. So you add all these things up. This is where the gross Treasury debt supply is going to come over the next 12 months. And so that sums up to 12.5 trillion. We can haircut that to 11.5 trillion because we know that this is the wrong number for the budget deficit. But $11.5 trillion, where we going to find the money to get that, right? That's kind of the key takeaway. It's a significant acceleration from where we currently are. And also, you think about the incremental debt that we're going to be adding on in the context of rolling over this debt that's maturing and capitalizing the incremental deficits. You're talking about a approximate roughly 100 to 120 billion dollar increase in the interest expense, just purely as a function of going from a Treasury portfolio that is currently yielding X to the market rate. It just rolling over, essentially $11.5 trillion of current Treasury stock into the market interest rate. And if you roll that over, you're talking about an additional, $100+ billion of interest expense on the U.S. government's balance sheet. So investors need to be aware of that. The incoming Treasury Secretary Scott Bessent has been inappropriately, in our view, critical of outgoing Treasury Secretary Janet Yellen's dovish net financing policy. And by the way, I've known Scott for almost 10 years. I don't think he'll be too angry if I said that I have a different view on him on this. Fellow Yellen. In our view, Janet Yellen did what she had to do. But let's just talk about what exactly happened, and then we'll kind of get to the conclusion. So in this chart, we just show marketable Treasury debt outstanding at $28 trillion. We look at the bill market at $6 trillion of that. The bills outstanding divided by total U.S. Treasury market debt is now up to 23%. And so that number, that 23%, has increased 7 percentage points, 700 basis points from the low of late 2022. Offsetting that was the total amount of note supply in the marketable Treasury market at $14.4 trillion. It's roughly about half of the total outstanding amount of marketable Treasury debt, and that ratio declined 600 basis points since the late 2022. So we've seen a real kind of decision by Treasury Secretary Yellen, outgoing Treasury Secretary Yellen, to concentrate issuance on the short end of the curve, so much so that we've had a meaningful, kind of shift to an above trend ratio of 23% of bills divided by bills to total Treasury market debt outstanding, and we got a below trend ratio of 51% of notes to total marketable Treasury market debt outstanding. So you can see that he's got a point. She definitely did do what he's accusing her of doing. We just take we have a different view on this, in the sense that she kind of had to do what she had to do. She had no choice. More coupon supply risked turning the regional banking crisis into a global financial crisis. That was the risk. Remember, if the Fed didn't do what it did over that weekend, and Janet Yellen just said, "Hey, I got my head buried in the sand. Here's another $500-600 billion of coupons and another $2 to $3 billion, $100 billion of bonds," we would have had a global financial crisis. That would have materialized into a global financial crisis. And so, in our view, we think she did what she had to do. And even if you disagree with that statement, let's say the regional bank crisis was always going to be contained. Still, the bill market represented the cheapest spread relative to the Treasury's existing financing costs. So if you look at the average Treasury yield across the current Treasury curve, so the market yield right now, the average market yield relative to the weighted average interest rate on total marketable debt, right now it's plus 97 basis points. So if you were just to take a random piece of Treasury paper and refinance it into the current market rate, at random at some point part of the curve, at a random part of the curve, you'd be basically paying 100 basis points more in that refinancing. You'd be doing 152 basis points more on the 10-year on the note market. You'd be doing 127 basis points more in the bond market, and you'd be doing 100 basis points more. The refinancing would cost you 100 basis points more in the TIPS market. The bill market has a minus 63 basis point discount. So again, if you rolled over an existing Treasury bill right now into the bill market, you'd actually get a discount. And so obviously that discount has only persisted for the past, let's call it 5 quarters or so, 4 or 5 quarters or so, but it's been persistently the lowest kind of positive spread or the deepest negative spread. There hasn't been another negative spread across the Treasury curve. So the key takeaway here is Janet Yellen made a very conscious choice to start concentrating Treasury issuance on the short end of the curve for 2 reasons, in our opinion. One, to reduce the pressure on the regional banks so that the regional banking crisis wouldn't ultimately deepen into something much more onerous for the economy and asset markets. And 2, because it was just smart net financing policy. This is where you get the cheapest discount relative to the average roll that you would experience, the average increase in financing costs that you would experience from the rest of the Treasury's existing portfolio. So in our opinion, this was her decision to flood the market with bill supply was instrumental in freeing roughly over $2 trillion of trapped liquidity from the Fed's RRP. We had $2.4 trillion of incremental U.S. liquidity on the other side as a function of the flooding of the market with bill supply, and which obviously allowed the bill rates to rise above the RRP rates, and more importantly, which ultimately allowed this dynamic allowed the Fed's fake quantitative easing programs, aka balance sheet runoff, to essentially not have any impact on net liquidity and on bank reserves. And so to me, it was smart policy that preserved the business cycle through the lens of not deepening the regional banking crisis. It was smart policy that preserved the business cycle through the lens of goosing the stock market higher, goosing liquidity, which goosed obviously capital, which caused capital markets to remain open and buoyant. And we ultimately got some very positive economic dynamics and positive market dynamics as a function of her decision. As a function, she's not the only reason for this, but as a function of her decision to flood the market with bill supply. And so, in our view, going back to where we started this conversation with Scott Bessent, he has been hypercritical of Yellen's net financing policy. And, it suggests that we're probably going to have a change in net financing policy back to, the spread that we've been widening in terms of bills and notes. We're going to see a convergence. There's going to be less bill supply. There's going to be more note supply, potentially be more bond supply. And so that stuff, in our opinion, could cause some indigestion in asset markets through the lens of the Treasury's net financing policy. So that's a left tail risk that we need to be aware of as well. One, the U.S. economy is not currently projected to generate meaningful labor supply. So that suggests a net negative shift in immigration policy is likely to slow growth. And again, we're saying net negative because obviously the Biden administration the incoming Trump administration wants more legal immigration, and then they want to deport and or close the border. They essentially did close the border, southern border, and then we're going to stop illegal immigration. So on a net basis, just relative to the total number of people that can process customs, or I don't know what department processes immigrants, but relative to the total number of people that can process versus the people who are just coming in by the millions for years, that is likely to result in a net negative shift in immigration policy. And that's probably going to slow growth. And here's why. When you look at the growth rate of the U.S. working age population, the nominal year-over-year growth rate on a monthly frequency, so taking the nominal year-over-year growth rate and then divided it by 12 to get a monthly frequency, the U.S. working age population is growing here in 2024, roughly 40,000 bodies per year, or per month, 40,000 bodies per month. In 2025, it's projected to grow 32,000 bodies per month. The current 3-month moving average of non-farm, private sector non-farm payrolls, inclusive of the hurricanes, is 138,000. So if the working age population is only going to grow 32,000 per month in 2024, at least according to the UN World Population Statistics, how are we going to maintain an above trend level of economic growth? How are we going to maintain a robust level of economic growth if we have a net negative shift in immigration policy that reverses the positive labor supply shock that contributed to the resiliency of the economy over the past a few years? So I think investors need to be very aware that there's a lot more economic risk associated with the Trump administration's policies than I think is bandied about. We all know that tax cuts and deregulation is coming. That's bullish. We don't need to tell, you don't need to listen to me tell you that. That's obvious. What you need to listen to me tell you is what's not obvious, because it may cause problems in asset markets, is what we're talking about in the left tail risk section. And then so the key takeaway here is the incoming Trump administration will be more friendly for asset markets. Sorry, my apologies. Let me read that over. The assumption that the incoming Trump administration will be more friendly for asset markets than the outgoing Biden administration from this starting point, particularly where we are in the positioning cycle, is a dangerous assumption. That's a dangerous assumption. It's not like the Biden administration, was bad for asset markets. It was bad for, working class people in America, as evidenced by the bright red electoral college map on November 6th. But it was not bad for, the people at the top part of the K, the people with asset holders. If you look at the return of the S&P 500 throughout the Biden administration, from index to his inauguration date, up 58%. Which compares to up 67% for Trump for his entire presidency. We're literally tracking right on the same level. And so if we, again, investors need to be aware that it's not like, you can have, especially if you're a Republican, or, you live in the Ronald Reagan dogma. I'm not making fun of you at all. I'm just saying, if you're naturally going to be inclined to say everything's all better now, right? That's your natural gut inclination, and from an economic standpoint, it probably will get better. And at least it's what we saw in 2016 through 2020, or prior to 2016 to, let's call it, end of 2019. Things got a little weird in COVID, but we'll ignore that. The key takeaway is that the markets have done quite well. The rich people in this country have done quite well in the Biden administration. And you can layer on where we are in the position cycle, which you guys can obviously very clearly observe in our lead off morning notes every day, or in our around the horn, or in our quantitative risk management summary. From this starting point in the position cycle, assuming that our triple S's theme with respect to the size, sequence, and scope of policy implementation is just going to be a ubiquitous straight line up, I think it's a real dangerous assumption. Again, we're exiting a regime where that was incredibly favorable for asset prices. We're exiting a regime that was incredibly favorable for rich people, the top part of the K, the asset holders. And so, transitioning to the next regime, just change in and of itself could cause problems in the context of where we are in the positioning cycle. So that's the key takeaway from this slide. That's the key takeaway from our left tail risk section in the context of our triple S's theme. We're concerned about tariffs potentially causing a strong dollar, which would ultimately exacerbate the global refinancing air pocket that there is a reasonably elevated risk of here in this year. And they were concerned about how immigration policy might contribute to a stickier and stickier inflation, and ultimately stagflationary dynamics in the economy through the lens of reducing the available amount of labor supply, which would restrain growth unless you had a productivity miracle, which obviously none of us has an ability to forecast. So we can hope for a productivity miracle, but the reality is, in the absence of a productivity miracle, you can make the case that the immigration policy from the incoming Trump administration is probably going to cause a stagflationary shock to the U.S. economy, alongside potential tariffs, which could then exacerbate the global refinancing air pocket that we could potentially be heading into in 2025. So didn't want to scare you. Hope I didn't scare anybody. That wasn't the purpose of the left tail risk section. The purpose of the left tail risk section is, again, to help you get fully abreast of the full distribution of economic outcomes, as we always are trying to do for you here in these macro scouting reports.